Today we're going to talk about unearned revenue. Let's suppose that on November 1st we receive $6,000 for work to be completed over the next 6 months. Record the journal entry for this transaction. So it's November 1st and we receive cash. We get $6,000. Now, the question is, what do we credit? A lot of students might make the mistake of crediting revenue, but the problem with that is we have not done the work yet. We have not earned our money. And remember, revenue is earned money. Okay, so what you have to do is you have to create an account called Unearned Revenue because you owe this client $6,000 worth of services. So you record your cash receipt of $6,000 and you credit the account Unearned Revenue for $6,000. And unearned revenue is a liability account. That means that you owe somebody something. And in this case, you owe a service worth $6,000. So it's not really earned until you do the work. So on December 31st, it's time to make adjusting entries. And remember, the purpose of adjusting entries are to bring revenue and expense accounts up to date. So our instructions say to record any earned income from this transaction. So it's December 31st. So the whole month of November and the whole month of December have passed. So that's 2 months worth of unearned revenue that is now earned. So what we're going to do in this journal entry is we're going to take $2,000 out of the unearned revenue account and we're going to put it in the revenue account. And this might be called something like, Okay, so we're going to debit unearned revenue and we'll credit something like an account called service revenue for that $2,000. So at the end of the year, the balance in the liability account is $4,000. That's going to show up on the balance sheet as a liability. Remember, unearned revenue is a liability. And then $2,000 of service revenue will show up on the income statement.